It's reported that the Reserve Bank Monetary Policy Committee will be meeting for the first time this year in 2023 to deliberate on the next move for interest rates in South Africa. The NPC will deliver its decision on Thursday, the 26th of January. Experts say that the interest rates in South Africa are approaching their peak, but we're not there yet, and the risks are very much on the upside. But how does this impact us? When the repo rate goes up, the commercial banks and other lenders put up their interest rates. This means that unless you have a fixed interest rate, you will pay more on your loans. In the short, the increase in the repo rate means that the cost of borrowing also increases. The repo rate is set by the Reserve Bank's Monetary Policy Committee and is the rate at which it lends money to the country's commercial banks. Adjust this rate in order to keep inflation within a 3% to 6% target rate. The theory is that by upping the repo rate, the Reserve Bank makes it less attractive to borrow money. This reduces the amount of money in the economy, so there is less to. The theory as spending slows down, it's harder to keep prices up, and this keeps inflation in check. So when the repo rate goes up, commercial banks and other lenders increase their rates as well. As a knock-on effect, the cost of borrowing increases with customers and consumers just like us. This means that if the interest rate goes up, then the cost of borrowing goes up, which means that the rate on your interest also goes up as well. So what can we do as consumers? The first thing that I think we can do is to have a fixed interest rate. So setting a fixed interest rate for a maximum of 5 years, which means that over a 20-year home loan, you'll need to renegotiate these terms. This means that the terms could be less favorable than when you first fixed your interest rate. An advantage of fixing your rate is that it's a sensible option and it provides you with some sort of protection from the increases in the future. However, banks have to hedge their own risks as well in allowing you to fix your rate. So when they allow you to fix your rate, it will be at a much higher rate than the rate you are currently. An advantage of another option that we have is to manage our budgets. So with prices increasing and our disposable income decreasing, we really just have to go back and manage our budgets and make sure cut down any luxury expenses. It's a good time to then go through your bank statements and check any subscriptions or any other expenses that you have that you may not need. In a previous video, I did speak about 2 types of budgets that I think are good for us to do in our lives. I'll link that in the video at the end of the screen, so please check that out after you finish watching this video. Remember that you can also approach the bank for them to give you guidance and options on how to manage your credit obligations. So if you're finding yourself in difficult situations, financial difficulty, remember to go and speak to your bank. They will provide you with guidance on how to manage these obligations and what options are credit obligations. If you're buying property for the first time, one thing that you can do is to buy new developments. Remember, when you buy a new development, these have no transfer costs, and therefore you are lowering the. If you're buying purchase, the cost of your acquisition, something else you can benefit from is to also save up for a deposit when you want to buy a house. The deposit can make a huge difference in the long term of your home, and so tightening your belt for a few months could be extremely wise. Purchase, the cost of your acquisition.